Institutional Market Point of Interest. In this module, I will be sharing in-depth details on the market points of interest. Market points of interest are the reversal zones in the market. These are the zones we are actually expecting the market to reverse from. As we are all aware, the market moves from one zone to another zone, from one reversal zone to another reversal zone. Those zones are what we call points of interest, and you can also tag them as areas of interest or reversal zone. This is actually the area and zone we are majorly looking to take our trade from. There are two major points of interest in the smart money concept. Number 1, order block. Number 2, fair value gap, abbreviated as FVG, or liquidity void. These are the three major points of interest whereby the market can be indecisive. The first on our list is the order block. So, what is an order block? Order block is considered a market behavior that indicates the pile-up of orders from banks and institutions. We have bullish and bearish order blocks. We need to know how to identify a bullish order block and a bearish order block. A bullish order block is a bearish candle we see before an impulsive bullish movement. A bearish order block is a bullish candle we see before an impulsive bearish movement. Although we have some major characteristics we need to see in the chart before we conclude that it's a tradable bullish or bearish order block, because it's not all those patterns that are actually tradable. So what characteristics do we need to see on the chart before we conclude that it's a tradable order block? Number 1, it must actually take out liquidity. In bullish order block, the red candle before the green impulsive move must take out liquidity first. While in bearish order block, the green candle before the red impulsive move must take out liquidity first. Just hold on, we're still going to discuss better on the chart. Number 2, we must see an impulse movement away from the order block. Number 3, we must see a break of market structure. I talked about market structure and the break of market structure in the last video. Number 4, the impulsive candle must be an engulfing candle. So these are the 4 major points we need to validate before confirming whether an order block is tradable or not. We can ignore rule number 1 and 4 in some trades, but rule number 2 and 3 is significant. That is, we can do away with liquidity and engulfing rule, but the break of market structure and impulsive move are a must. Suppose you can find all 4 rules. That's perfect. In this chart example here, we can see a clear bearish order block here. This bearish order block is fulfilling all our 4 rules. Here is the green candle before the impulsive bearish move. Number 1, the green candle cleared out all the liquidity above this wick over here. Number 2, we see a bearish impulsive move after clearing out liquidity. Number 3, a break of market structure here, because we can say this point is low after creating a high at the top of the wick here. So here is the break of market structure BOS. Some traders abbreviate it as BMS. Lastly, we can see an engulfing candle here, thereby fulfilling all our 4 rules. So you can mark the green candle and extend your line out. Most times, I prefer to mark the wick to wick. You can mark the body to body alone as well. In this chart example here, we can see a clear bullish order block here. This bullish order block is fulfilling 3 rules. Here is the red candle before the impulsive bullish move. Number 1, the red candle cleared out all the liquidity below this low over here. Number 2, we see a bullish impulsive move after clearing out liquidity. Number 3, a break of market structure here. Break above the high over here to print a new higher highs. So here is the break of market structure BOS. Lastly, we can see that this candle didn't engulf the previous candle, but we are still valid because we fulfill 3 of the rules. So you can mark the red candle and extend your line out. That's our bullish order block. Most times I prefer to mark the wick to wick. You can mark the body to body alone as well. So let's move to the fair value gap. Fair value gaps are simply liquidity void in the market or point of imbalance. In a bullish fair value gap, we can notice high buying pressure. In a bearish fair value gap, we can notice high selling pressure. Most traders regard these fair value gaps as points of imbalance in the market. When price now comes back to these fair value gap zones, there is the possibility that price can reverse from those zones. Let's take a look at the fair value gap in our chart here. Connecting the low of this candle to the high of this other candle, you can see high selling pressure over here. So we can call that zone a bearish fair value gap. Also, if you connect the lows here, you can see a bullish fair value gap here. This zone has high buying pressure. Price later came back to fill it over here. This zone here is not a fair value gap because the market already filled it over here.